The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com. Hello, everyone, and welcome to this month's Bucket Plan On Demand. This is Dave Allison and Jason Smith joining you today, and we're going to be talking about the cash flow analyzer. And so, as we all know, analyzing a client's cash flow is so important, whether you're helping them through the accumulation years, determining what type of disposable savings that they have, or you're getting ready to prepare for the distribution years of the money cycle. By going through the cash flow analyzer step, you're going to be able to determine how much the client will need to draw from liquid investable assets in retirement. You're going to identify an income surplus for a pre-retiree that you could allocate towards a savings plan. And you're going to understand how much of the client's income they want guaranteed and the 3 ways to guarantee it if you're starting to build an income distribution plan. To achieve the cash flow analysis, Clarity to Prosperity has developed 2 different tools that you have the ability to use to help guide you through the cash flow analyzer. On the left-hand side, you're going to see a tool called the Cash Flow Budgeter. This is where you may need to go to if you need to identify more particular budget items for a client to help determine kind of line by line what some of their main categories of monthly spending are, annual spending, and what some of their sources of income, like salary or bonus or commission. It could be Social Security or pension income if they're already retired, or it could be rental income potentially. And so we're going to go a little bit deeper into this tool, but the main portion of this tool is to take their actual net income that they have minus their projected expenses and quickly get you to a place where you're going to identify, do they have a monthly cash flow surplus or do they have a monthly cash flow deficit? And whether you're doing pre-retirement planning, the surplus could help you determine what their monthly savings could be to add to their accounts, or whether you're getting ready for retirement distribution planning, the deficit could be the income gap that you need to solve for that they're going to need to draw from their investable assets. Now, over on the right-hand side, this is a tool called the Income Gap Assessment. I love this tool. This tool is very helpful for a client who's about 10 years or less from retiring. So they're getting into that retirement readiness zone. And basically what we're doing is a simple shortcut to a budget to determine what their income gap is. And by income gap, I mean the amount of income they're going to need to take out of their investment accounts to maintain the standard of living that they desire. And again, we're going to go into both of these tools in more detail. But what I want to share is a couple inflection points of where you might go to one versus the other. So I mentioned the income gap assessment first, the tool on the right-hand side. This, again, is going to be really helpful for clients who are less than 10 years out from retirement. So they don't have a long time horizon before they're going to retire. You don't need to project out a lot of potential changes. Like, if you're doing a plan for a 40-year-old who wasn't going to retire till 65, the income gap assessment might not be the best tool to project out their income needs in retirement. You might go to other softwares or the cash flow budgeter. But if you have a 63-year-old who's going to be retiring in the next 2 years, the income gap assessment is a fantastic tool to shortcut all of the traditional budgets that you might need to do. Now, the other place that the income gap assessment is useful is if there's not a lot of, I would call it lumpy cash flows. So there's not a lot of, Social Security delays, bridges for Medicare, starting and stopping of different income amounts. But if you have a client, they're 63 years old, and if you could replace the net income that they're living off of right now while they're working in retirement, and you have a good idea of when their Social Security or pension's going to start, and there's just an amount of income that you can determine you're going to need to draw off of their investable assets to supplement that Social Security or pension, the income gap is a great tool. Now, on the flip side, the cash flow budgeter, you're going to primarily use this tool for a couple different areas. Number one, any younger client. So anyone who's maybe more than 10 years out from retirement, where you're not really trying to figure out an income gap in retirement now, but you're more trying to determine how much excess cash flow do they have today that we could potentially reallocate into a systematic savings plan to help them build the assets that they're going to need to ultimately be able to retire one day. The other area you might use the cash flow budgeter is if you do have a client approaching retirement or already in retirement and they need a little bit more help budgeting certain areas of spending. And we're going to talk a little bit more about that in detail. But the reality of it is both of these tools use something called the consumption methodology of budgeting. Now, the American College teaches the consumption methodology, and instead of trying to predict out a lot of future expenses, the baseline or starting point for the consumption methodology is taking what their net income is today after taxes are withheld and 401k contributions, and determining how much of that they're going to need to consume when they go to retire. And we'll show some specific examples as we dive into the tools. So let's start with the income gap assessment. This is going to be your go-to tool for anyone within 10 years of retirement where you want a quick consumption budget. And so we're going to dive into the individual sections of this tool. The first section at the top is the income lost in retirement. So remember, I shared the basis for everything is the consumption methodology. So what we want to try to determine is how much income the client is consuming now. And in retirement, if we could replace that same amount, would that be sufficient for them? So again, if you think about it, most clients have some sort of income coming in right now from their employer. It's basically their paycheck, right? And in this case, we have Joe and Sally. Joe is currently working at the Cleveland Clinic, and net after taxes, retirement contributions, benefit withholdings, he gets $2,934 deposited into his account. And we ask Joe, how frequently are you paid? And he tells us he's paid bi-weekly, so 26 times a year. So you can see we have Joe's name on the left-hand side under client name. The source is the Cleveland Clinic, and the amount, the net income deposited into his checking account is $2,934 multiplied by, to total one whole year, 26, because he's paid bi-weekly, 26 pay periods in a year. So you can see over the course of a year, Joe has net income of $76,284. And again, I want to stress that's a net number because it already factors his tax withholding, it already factors his retirement contributions and any benefits that he may be paying through payroll deduct. And so again, the net income going into his bank account that he could go spend. Now his wife Sally works at Avon School System, and she gets paid $2,500 net in her account 12 times a year, so that's $30,000. Now, a couple tips, if you ask the client this, first off, most clients know what their net paycheck is going to be. But if they don't, you could find it in a couple different places. You could ask them to bring in their latest pay stub, because pay stub shows their gross pay amount and their net pay, and it shows what their withholdings were. And so if they brought in their pay stub, you would just use the net amount in that column. Now, if they couldn't get their hands on their pay stub, You could simply have them just log into their bank account or bring a bank statement. And on the bank statement, it's going to show their net pay. Obviously, the bank statement does not show their gross pay, it shows their net pay. And so down at the bottom in that lightly red color, the shaded red, you can see annual income lost. And so the annual income lost is $106,284. Now, why is that an annual income loss? It's an annual income loss because when these clients both retire, they're not going to get paid that amount anymore from the Cleveland Clinic or from Avon School System. So that's going to be lost income. Think about it like an old accounting system. We're talking about debits and credits here. That's a debit because it's going to go away. And now when you get to that number, if you're thinking about retirement planning, and you ask the client, Joe and Sally, in retirement, if we could replace that same amount of net income, that $106,000, would that be sufficient for you? Or at the end of the year, do you find yourself doing one of three things? You're making and bringing $106,000 into your bank account. Do you find at the end of the year you're breaking even, meaning you're spending about all that you're making, so you're consuming everything that's coming in? Do you find yourself creating a saving surplus, meaning you're saving a little bit more than you're making? Maybe at the end of the year, you have $6,000 left in your checking account. So maybe you're spending $100,000 and $6,000 is left. Or do you find the third thing that you're spending more than you're making? You're actually consuming more than you're making. You're running up credit card debt. And so where the income gap assessment comes into play is if they're saving, right? And they're in that first category where they're saving more than they're making, or they're breaking even, you can really continue on using the income gap assessment. Now, if the client is going into debt each month or each year, you probably need to go to more of a full-blown budgeting exercise because you need to really rein in their spending. But in this case, the client tells us that's a good amount for them. $106,284 is the amount of money that they're going to lose from their employer paycheck net after taxes and withholdings when they retire. Now, the next section on the income gap assessment is going to be income gained in retirement. And this could be through the form of Social Security or pensions. And so in this case, Joe is going to elect to take Social Security at age 70. So we did some Social Security optimization, and we found the optimal mix for Joe and Sally are for him to take it at age 70 and for her to take it at full retirement age 66. And so we can see here, Joe's Social Security is going to be $2,100 a month, and it's going to get paid monthly. So at age 70, he's going to get $25,200. Now, Sally's Social Security is going to start right away at full retirement age when she retires. They're also planning on retiring at age 66. In this case, they're both age 66. She's going to get $584. That's going to get paid monthly. So about $7,000 in Social Security benefit for her. Now, these numbers in this case are plugged in as gross numbers because not all Social Security is taxable. And I'm going to share with you how you adjust for taxes in just a moment. Now, on top of that, Sally, because of her job at the school system, she's eligible for a nice pension. $3,300 a month. That's part of the reason her Social Security is actually so low. But her pension is $3,300 a month. And so that's $39,600. So you can see by the time Joe is age 70, they're going to have about $71,800 of fixed income addition in retirement. Now that's like a credit. Now, I want to go back and address the Social Security because what that is showing is that income is not going to be coming to fruition completely until 4 years down the line from now. Remember, they're 66 right now, and we're not showing Joe's $25,200 kicking on until age 70. And so what we recommend doing in this case is build the retirement income plan as if full Social Security is kicked on. So basically, they're going to have $71,808 of fixed income. But we know we have a 4-year gap, age 66, 67, 68, 69, until age 70, that we're going to need what's called a Social Security bridge. And so in that case, we know we need $25,000 to make up for Joe's Social Security because we're delaying it. So 25,200, and let's say we even want to have a little buffer to get through 5 full years until the time that that Social Security paycheck will come on. So if we take 25,200 times 5 years, we know we need $126,000, assuming no interest or growth, just on a very conservative basis, to put in the soon bucket, and we would label that Social Security bridge. And so what we would basically show in our income projections is we're going to spend down that $126,000 over 5 years, which will basically be a substitute for this Social Security from age 66 to full delayed at age 70. That would produce 25,200. Then at age 70, once that Social Security check kicks in, you're going to see we'll have spent that bridge, and now we'll have the total 71,808. So what we find a lot of times is people get confused with using this income gap, particularly in concert with Social Security optimization. And just think of keeping it simple for the client. You show the client Social Security at age 70, and then you just sit back and explain to them that because this isn't going to kick on till 70 and you're only 66 now, we basically just need to create a 5-year Social Security bridge in your soon bucket with the assets. And so now this fixed income addition, this is shaded in light green because that's going to be a credit in retirement. Now the third section is going to account for any adjustments. So we could have adjustments in the form of increased expenses in retirement, and we could have adjustments in the form of decreased expenses in retirement. So some examples, as you can see, of increased expenses in retirement could be income taxes. For example, maybe we now need to go make estimated tax payments because of the gross pension number and the gross Social Security number that we showed up top earlier. In other cases, maybe they tell us they want to have, more money to go travel the world earlier on in retirement. Or in some cases, maybe they had really good health insurance at their employer and they weren't responsible for any portion of it. And now they're going to have Medicare or Medicare supplement costs, or maybe even they're retiring before Medicare kicks in and we need to account for health insurance expense for one reason or another. And so in this case, we're showing 2 examples of increased expenses in retirement. This client tells us they want to have an additional travel budget of $5,000. They're going to go on one additional trip per year. It's going to estimate to be about $5,000. And so you can see we put in $5,000 one time per year. And then you can see we also added taxes in here. And we put in $2,000 as an estimated tax payment 4 times a year. So that's $8,000 of estimated taxes. So you can see down at the bottom in red again, this is an example of a debit. Increased expense subtotal is going to be $13,000, our travel budget plus our estimated taxes. Now you might be saying, well, how did you get to that estimated tax payment amount? In this case, and we're going to simplify it, this client lives in Florida, so there was no state income tax, or else we'd also have to factor that in. But you could see here, we ran a tax what-if analysis. And in this case, if you're not comfortable with tax what-if, we definitely have additional training through the tax management journey you can come and attend. There's tax softwares out there like Tax Clarity. This is an example of using Tax Clarity, where we would plug in the client's Social Security income of $32,000, plus the amount of total ordinary income that they have, in this case, $64,276. Standard deduction for both being over age 65. You can see based on this retirement income plan, they're going to owe about $7,400 a year in tax. And so we just rounded that up a little bit to be $2,000 per quarter of estimated taxes that we need to make sure we're accounting for. Now, the other thing is if they were in a state with state income tax, that gives us a little bit of a buffer for the state income tax as well. But how we get to that tax adjustment is by either doing a tax what-if analysis on your own if you're comfortable with it. The other is if you have a tax professional that you have a good working relationship with, you could potentially provide them the numbers, how much Social Security income, how much pension income, how much you're going to estimate to take out of their qualified retirement plans, and they can give you an amount of estimated taxes that that client should have to pay. Now remember, if you're adding more for estimated tax and that's coming out of a IRA, you might even need to gross it up a bit more to cover the tax on the additional withdrawal amount that you're pulling out for the IRA. But in this case, we factored that in. It came to $7,373. So we added that tax adjustment of $8,000. Now, the second section under adjustments are decreased expenses in retirement. So examples of decreased expenses in retirement are at the beginning of the exercise. If the client told me that they were saving each year, so they had $106,000 coming into their bank account, and if they told me they were saving $20,000 a year of after-tax money, well, when it comes to retirement, I don't need to build a retirement income plan that is creating additional savings for them, accumulating money in their checking account. Why pay tax on it and take money out if they don't need it? So this is the section that if they told me they were having accumulating savings, I would just add an adjustment that said savings. I would put the amount of savings they're averaging, and that would actually become a decreased expense in retirement. Other major decreased expenses that we see are the mortgage payoff, or in some cases, health insurance. So in some cases, the employee was paying a pretty good chunk of money out of pocket for health insurance while they were working, but once they're eligible for Medicare, their health insurance expenses actually go down. And so you can factor those adjustments in here. In this case, this client had just one simple adjustment. They were going to pay off the mortgage. That was going to be $1,850 of mortgage expense 12 times a year. So in this case, they're going to have a decreased expense of $22,200. And again, that's like a debit in this situation. It's in the green shaded area of the income gap assessment tool. Now, the bottom section of the income gap tool basically subtotals the debits and the credits. So what you're going to do is you're going to insert the total of anything highlighted in green. So the things highlighted in green would be the decreased expenses in retirement, and it would be the income added in retirement through Social Security or pensions. And so as you could potentially remember from earlier, this client had Social Security income and pension income, plus they were going to pay off the mortgage of $22,000. So if you add all of those together, they're going to have $94,008 as that green section. That's going to be basically income gained in retirement. And then the red section is income lost in retirement plus any increased expenses. And so as you could remember earlier, they were going to lose about $106,284 from Cleveland Clinic and Avon Schools. And they were also going to have increased expenses of $13,000. So if you add up those two boxes in shaded in red, you get $119,284 as the amount that they're going to lose in retirement. And so basically in that next section that says annual income gap or excess cash flow, you're going to see that $119,000 in the negative plus 94,000 in the positive gives us a negative amount of 25,276. Now that's an income gap. It's a negative amount. That's the amount that we're going to have to pull out of their investment accounts to maintain the standard of living that we agreed upon they want. Now, in some cases, particularly where a client has a really high pension amount, you might find that they actually have an income surplus or what's called excess cash flow. In that case, they never need to pull a penny out of their retirement accounts to live off of. They actually have a surplus, and there's a lot of planning opportunities if they have a surplus. But for most of our clients, they're going to have to need to pull money out of their investment accounts to supplement their Social Security and pensions in retirement. And in this case, as you can see, this client's going to need to take $25,276 out. Now, at the bottom of the income gap, it asks, how much of this income gap would you want guaranteed in your financial plan? That is such an unbelievable question to ask the client. How much of the income gap would you want guaranteed in your financial plan? And what do you think clients say? Well, generally, clients are going to say one of two things. They might say, well, what do you mean by that? Or in other cases, they might tell you an exact percentage amount. Oftentimes, clients say, well, I want 100% of that guaranteed. That's what I need to live off of. And so what it gives you the ability to do is document in the financial plan how much of the client's income they want guaranteed. And if they ask, what do you mean by that? It gives you an educational opportunity to bring up the fact that there's really only three ways to guarantee income. You could guarantee it through the bank by basically laddering CDs. You could guarantee it through the government by basically laddering government bonds, or you can guarantee it by an insurance company like pensions do, by buying an annuity. And so those are the only three sources, and it helps navigate how much of the client's income they are going to want guaranteed in their financial plan. So if we summarize the income gap assessment, as you can see here, you're going to do a quick consumption budget for your client. You don't need to bring out all kinds of advanced or complex software. You don't need to give your client a really robust homework assignment to forecast out all their expenses in retirement. We're simply taking the amount they're consuming now, factoring in how much fixed income they're going to have in retirement, factoring in any increased expenses or decreased expenses to get to a net number. And because we're doing a tax pro forma in this case and factoring in tax planning, we're also factoring in Social Security optimization and adding a bridge in the soon bucket to get them through the Social Security delay. There's a lot of comprehensive planning techniques, but it's one simple underlining tool with the income gap assessment to get to that bottom line number. And then, of course, asking them how much they want guaranteed in their plan. Now, the second tool within the cash flow analyzer is the cash flow budgeter. This is where you may pivot to if you need a more robust budgeting or planning tool. The cash flow budgeter is basically broken into three main sections. I'm going to go through a couple different examples, one for a younger client and one for a retiree. So with the younger client, you can see with this tool, you basically only edit anything in the green section. And a lot of them are drop down. So you simply just choose what's most appropriate. So you edit this, in this case, it's the Davis family cash flow budgeter and the date we completed it. And then you can see we have two clients. We have Irene and Johan. Now this is a younger client. They're still working. And what you can see in the first section is we have what their income sources are. In the drop down, you can see, is it going to be their salary? Is it bonus income? Is it commission? Could it be Social Security, pension, or even rental income? And what you'll see is this tool gives three sources. So sometimes you might have a client that's got salary and a bonus, and maybe they even have rental income. Or you may have a retiree that has Social Security and a pension. So you would list each individually. The next section shows the pay frequency. So are they paid annually, maybe like an annual bonus, one time per year? Is it bi-weekly pay, meaning they're paid 26 times per year? Is it monthly, 12 times per year? Is it quarterly, 4 times per year? Semi-monthly, which is 24 times per year? Semi-annual, which is 2 times per year? Or are they paid weekly, 52 times per year? So in each section, you're going to put in what the pay frequency is. What the software in the Excel file is going to do is it's going to subtotal up what the annual take-home pay is. So what you would do is the third section, once you put in the salary or the pay type, in this case for Irene, hers is a salary, you put in the pay frequency. In her case, she gets paid weekly. Then you put in there her take-home pay amount, which in her case is $4,000. You can see her annual pay is $208,000. Johan over on the right-hand side, he's getting paid a salary bi-weekly, 26 times per year. His take-home pay is $2,200, so his annual pay is $57,200. Down below there, they have rental income that comes in monthly of $300 net after expenses. That's $3,600. And then you can see Johan gets a bonus. It's a semi-annual bonus 2 times a year in the amount of $10,000 each. So the total is $20,000. Now down at the very bottom, it adds up all these annual sources of income. And you can see this family has total take-home pay for Irene of $211,600. That's her salary plus the rental income. For Joanne, it's $77,200. That's his salary plus his semi-annual bonus. You add the two of those together, and that's their total household take-home pay. In the section right below, it adds everything together. So as I mentioned, you can see their total take-home pay before tax adjustments is $28,800. Now, what I generally would do up top is I put their net take-home pay that they're getting deposited into their checking account, because that already factors in tax withholding, 401k contribution, any pre-tax retirement contribution withholding. And so it gets me to a net number of how much money they're having come into their account. Now, in this case, the tool is flexible though, because Irene, her salary, she's self-employed. She's a 1099 contractor. So she has no tax withheld. So what we had to do is we had to run a tax what-if scenario to estimate her tax payments. And we factored based on everything, they were going to have to make a tax adjustment and pay $59,000 of total tax between state and federal. So what you can see is they have $288,800 coming in, but we need to do a negative tax adjustment of $59,000 to account for the estimated payments we're going to have, which leaves us with total adjusted take-home pay of $229,800. Now, what if the clients were both W-2, no self-employment income, and we looked on their tax return at the end of each year and they were getting a refund? Well, what you could do in that green box as the adjustment is put in that positive refund number. So in this case, if they were actually getting a $5,000 refund, I would put $5,000 in there, because we want to factor that into their total adjusted take-home pay as well. That means basically they're withholding more than they need to. They're getting a refund. So that's income coming back into their account that could be deployed to pay expenses or as part of their savings plan. And so again, all you need to edit is the green boxes. The next section of the cash flow budgeter shows some high-level expense categories to get the client thinking and compartmentalizing their expenses. What I basically like to do is I take this, and if before the appointment with the client, I send them these categories, and I ask them to map out what their monthly expenses are in each of these areas. And I could either have them email it back to me before the meeting or just bring it into the meeting. But I take those monthly expenses and I just put them in the green shaded area. And then of course, over on the right-hand side, you can see it annualized. So for example, this client has a mortgage payment of $2,357. So that's an annualized mortgage of $28,290. Property tax, auto payments, gas, childcare, clubs, and association dues. There's a number of different categories there. A couple things you'll note is after-tax plan savings. So if they're already saving a certain amount, I could put that in. If they don't know how much they could be saving, I just leave that blank. Charitable giving. And then last but not least is all other spending. So everyone has all the little random things here and there. That's a kind of a catch-all category. And so what you can see with this client is they spend about $9,000 a month, or about $107,000 a year. And so what it does over in the right-hand side is it creates what their monthly cash flow surplus or deficit is. So this client actually has a monthly cash flow surplus of $10,230. And what that tells me is I have $10,230 to allocate to the most appropriate savings strategy to help them reach their goal. This is a younger client. So I'm going to use the tax efficient funnels that we do of pre-tax, post-tax, and tax advantaged to allocate that $10,230 between a savings plan within those buckets. It's a quick, easy way to get to that number. This is an example of the cash flow budgeter for a retiree or a pre-retiree. So you can see now in this example, we're dealing with the Baldwin family. We have Susan and Philip. And under paycheck number 1 for both Susan and Philip, we have their Social Security check. And so Susan is getting $750 per month. And Philip is getting $1,900. So $9,000 for her, $22,800 for him. She has a pension of about $2,100 a month, and that is paid monthly. And then they have rental income, which is showing up under him, of about $1,200 per month. And so you can see in each category, take-home annual pay, $34,200 for her and $37,200 for him. That's basically the inflows that they would have into their bank account upon retirement. In the middle section, under the tax adjustment, we're going to make some estimated tax payments. And so in this case, based on that gross income above, they're going to owe about $8,000 per year in taxes. Comes out to about $667 a month we're going to allot for taxes. You can see in this category, the tax adjustment here is in light green on the annual, because again, when we do tax analysis for the return, a lot of times it just comes out as annual. And so down below on the left-hand side, same basic concept. We're wanting them to forecast out what their expenses are going to be in retirement. So, again, not every category, but most of the main ones, plus another category as a catch-all. In this case, this client is going to have $71,400 of total take-home pay before adjustments in retirement. That's their Social Security, pension, and their rental income. We're going to have to make a tax adjustment of $8,000 for taxes. So you can see their total take-home pay, which is all their fixed income minus the tax liability, is about $63,400. Now you can see based on all the monthly expenses down below, they're going to have about $7,500 per month of total monthly expenses. That's $90,000 per year, you can see under the annualized column. Well, simple math tells us $90,000 minus the $63,400 is $26,600, and you can see that depicted over on the right-hand side. They have a monthly cash flow deficit of $2,216. That's the amount in retirement we're going to have to pull out of their investment accounts for them to supplement the lifestyle that they want. And down below, it just shows that annualized amount of $26,600. We shared earlier for a client who was retiring or really within 10 years of retirement, the income gap assessment, quick, easy way to get to that $26,600. This is a little bit more robust of a way to get to that $26,600 because we're looking at all these expense categories versus what we did in the income gap was just start with what they were already consuming. So to recap, the step in the financial planning process where you're analyzing the client's cash flow, we've developed these two quick, easy tools, either the cash flow budgeter to get you to the point of how much of an income gap or an income surplus they're going to have each month and each year, or the income gap assessment, which is the quick, easy consumption tool to arrive at what their income gap will be in retirement and how much of that income they would want guaranteed. Again, the cash flow budgeter, you're probably going to use for your younger clients to figure out savings and accumulation plans. You could potentially use it for pre-retirees or retirees who need I call it a budget light version, right? Not a whole blown budget exercise, but just forecasting out some of the basic expenses. You'll use the income gap assessment when you're looking for that shortcut to figure out how much that client's going to need to draw out of their liquid investable assets to supplement their fixed income in retirement and determine how much of that they want guaranteed in their financial plan. So again, these two tools were built so that you could quickly get to that number without putting your clients through the misery and the pain and yourself through the misery and pain of a full-blown budget exercise. And don't forget, as always, download the white paper. You can go through and see it in paper form, some of these different tools and how to use them. So we appreciate you jumping on the Bucket Plan on Demand, and we look forward to speaking with you next month. The Bucket Plan on Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.